Legal & General Group plc (LGEN) represents a structurally advantaged high-yield investment proposition supported by robust capital reserves and market dominance in the secular growth segment of UK pension risk transfer (PRT). The investment case is predicated on LGEN's ability to generate reliable, long-dated cash flows from its substantial annuity backbook, which funds a major multi-year shareholder return program. Management is actively executing a strategy of simplification and enhanced capital efficiency, aiming to transition towards a more capital-light model and unlock value currently obscured by complex insurance accounting standards. While standard IFRS-based valuation multiples appear highly distorted, the underlying operational metrics confirm the security and sustainability of the investment proposition. 1.2. Financial and Strategic Highlights FY 2024 Snapshot. The group demonstrated strong financial performance in the fiscal year 2024, underpinning confidence in its strategic direction. Core operating profit grew 6% to 1,616 M, complemented by a 6% rise in core operating earnings per share (EPS) to 20.23p. This consistent underlying growth contrasts sharply with the volatile reported IFRS profit before tax of 542 M. Crucially, the capital position remains exceptionally strong. The Solvency II coverage ratio strengthened to 232% by the end of 2024, an improvement from 224% in 2023. This buffer is supported by Solvency II operational surplus generation (OSG) of 1,751 M for the year, too, which comfortably covers the cost of dividends paid, providing high confidence in the cash flow needed for distributions. Strategically, LGEN has committed to a substantial program of enhanced returns. The group plans to return over $5 billion to shareholders over the next 3 years, incorporating both dividends and share buybacks. This commitment commenced with an initial $500 million share buyback in 2024, alongside the confirmed intention to increase the full-year dividend by 5%. 1.3. Key risks identified. Despite the favorable cash flow and capital profile, LGEN faces several risks. The most immediate is the distortion of public valuation metrics, where reported PE and PB multiples, e.g. 52.4x PE, 5.6x PB, dramatically diverge from peer averages, necessitating complex normalization for investors. Execution risk also exists regarding the achievement of ambitious divisional compound annual growth rate (CAGR) targets, particularly in institutional retirement (IR) and retail. Furthermore, the expansive annuity asset portfolio, valued at 92 BN, maintains a material exposure to credit risk. 2. Strategic realignment and business model transformation. 2.1. Group structure and the new vision. Legal & General operates through 3 primary synergistic business pillars: institutional retirement, IR, asset management, AM, and retail. The strategic focus, guided by CEO Antonio Simões, centers on achieving a sharper focus and delivering enhanced returns. This strategy involves directing capital and expertise towards areas that promise sustainable, long-term value creation. One major component of this strategy is the restructuring of the investment capabilities. LGEN has consolidated LG Investment Management (LGIM) and LG Capital (LGC) into a single unified asset management business. This integrated entity, boasting $1.1 trillion in total assets under management (AUM), is explicitly positioned as the critical long-term growth engine for the group. The combination is designed to leverage LGEN's deep asset origination expertise in private markets with its strength and heritage in public markets, enabling the creation of blended investment propositions and complex, responsible investment solutions internationally. Complementing this focus, LGEN has established a Corporate Investments Unit (CIU). The CIU's mandate is to oversee and ultimately dispose of assets and businesses deemed non-strategic or poor fit with the refreshed core strategy, even if some currently deliver strong financial performance. The disposal of assets, such as the sale of Kala, is part of this simplification effort. 2.2. Achieving a more capital-light model. The long-term strategic vision for LGEN includes a definitive move toward a more capital-light model. This transition is imperative because the institutional retirement business, while highly profitable, is inherently capital-intensive, requiring capital reserves to absorb new business strain under prudential regulation. The strategic simplification, specifically the merger of the investment arms and the creation of the CIU, is fundamentally necessary to sustain the high level of shareholder distributions promised. To support the planned $5 billion capital return over 3 years and maintain the targeted 5% annual dividend growth, LGEN requires increased capital velocity. By shedding non-core assets through the CIU and simultaneously boosting stable fee-based income via the scaled asset management business, LGEN directly addresses the need to increase capital efficiency and release previously committed or trapped capital. The business trajectory is supported by specific performance goals. LGEN anticipates core operating EPS growth to land at the higher end of the 6 to 9% range for fiscal year 2025. This growth is facilitated by near-term investment in the operating model, which positions the group to capture structural growth trends. The rigorous, disciplined approach to capital allocation ensures that freed-up resources are redeployed either to drive future growth or to enhance shareholder returns. This restructuring effort is therefore an attempt to improve the group's valuation multiple by shifting the profitability mix towards asset management, mitigating the negative valuation distortion typically associated with complex insurance liabilities under IFRS 17. 3. Financial performance and segmental momentum, FY 2024. 3.1. Reconciling core operating metrics versus IFRS profit. In analyzing LGEN and its UK life insurers, relying solely on IFRS-compliant accounting results, such as IFRS profit before tax, PBT, is misleading due to the volatility introduced by IFRS 17 accounting standards, which heavily impacts long-term liability provisioning and mark-to-market movements. Consequently, core operating profit and core operating EPS are the most reliable indicators of the group's underlying sustainable profitability. In FY 2024, LGEN reported a core operating profit of 1,616 M, marking a 6% growth over the prior year. Core operating EPS mirrored this growth, rising 6% to 20.23p. In stark contrast, IFRS profit before tax was substantially lower at 542 M. Investment analysis of LGEN must therefore focus predominantly on the core operating metrics. Institutional Retirement IR, the growth engine. The Institutional Retirement Division is the group's largest profit driver, capitalizing on the robust demand for defined benefit (DB) pension de-risking in the UK and internationally. In FY 2024, IR operating profit increased 7% to $1,105 million. The sheer scale of this business is significant, with the total annuity portfolio, including retail annuities, standing at £92 billion as of FY 2024. The division wrote £10.7 billion of global PRT in 2024, including £8.4 billion in the UK and record volumes in the US and Canada. This division is expected to deliver sustained structural growth, with operating profit CAGR targeted at 5 to 7% between FY 2023 and FY 2028. Future guidance remains strong, targeting UK PRT volumes of £50 to £65 billion over the 2024-2028 period, managed at a new business strain rate below 4%. The strategic partnership established with Miji Yasuda further enhances LGEN's growth potential within the US PRT market. 3.3. Asset Management, AM, pivoting for profitability. The newly consolidated asset management division, formed by combining LGIM and LGC, manages a total AUM of £1.1 trillion, with 44% managed internationally. The strategic rationale for the consolidation is to create new blended propositions that integrate public and private market capabilities, reflecting the evolving, complex needs of institutional clients. This pivot is designed to increase profitability by shifting the business mix towards higher fee margin products. Initial evidence suggests this strategy is taking hold. The average fee rate increased from 7 bps to 8 bps in FY 2024. This improvement is linked to the focus on private market assets, which reached £57 billion of AUM in 2024, and securing external committed capital through new fund launches. LGen aims to lift operating profit for the asset management business to between $500 million and $600 million by 2028, representing a CAGR of 6 to 10%. 3.4. Retail Division, Lifetime Partnership. The retail business focuses on partnering with customers throughout their lives, offering solutions for savings, protection, planning, and retirement. This division represents approximately 20% of the group's divisional operating profit. Management has set ambitious growth targets for the retail division, aiming for a 4 to 6% operating profit CAGR between 2024 and 2028. This is a material increase, exceeding the prior market consensus of 3% annual growth. Growth drivers include the reliable release of earnings from existing annuities and protection businesses and increasing operating leverage within the workplace defined contribution segment. The long-term success of the retail division is crucial for the group's capital-light objectives. LGen projects a significant shift in the retail profit mix over the next decade. By 2034, 40% of profits originated by retail are expected to be fee-based earnings, representing a substantial increase from below 15% in 2024. This growth will be fueled by securing £40 to £50 billion in workplace DC net flows between 2024 and 2028. This compounding fee income base will structurally improve the group's profitability profile, reducing reliance on capital-intensive underwriting and eventually replacing PRT as the primary growth driver for the UK annuity asset portfolio. IV, Capital Management and Solvency Framework. 4.1. Solvency II Strength and Capital Generation. The Solvency II coverage ratio is the primary measure of regulatory capital strength for European insurers. LGen's 232% ratio at FY 2024 signifies an exceptionally robust capital buffer, holding more than twice the capital mandated by regulators. This strength provides a substantial safety buffer against significant policyholder longevity/mortality risk, market shocks, and unexpected losses. Operational surplus generation, OSG, is the corresponding measure of deployable capital generated internally by the business. The FY 2024 OSG of $1,751 million, serves as the key proxy for free cash flow available for dividends, share buybacks, and investment in new business growth. A consistently high OSG is the foundation of LGen's dividend policy. The group also possesses a large store of future profit, SOFP, of $14.8 billion, representing unrecognized future statutory profits embedded within the long-term insurance contracts, providing a significant financial buffer. The current high coverage ratio is not merely a sign of prudence, but an indication of substantial operational flexibility. This financial strength allows management to pursue aggressive growth targets, such as the PRT volume guidance, while maintaining a low capital strain rate, below 4% for PRT. Critically, the strong capital position also empowers the commitment to major capital return initiatives, such as the $500 million initial share buyback, without jeopardizing regulatory stability or needing to raise new capital. 4.2. Regulatory Tailwinds, Solvency UK Reforms. Regulatory changes concerning the solvency regime are structurally beneficial for long-term annuity writers like LGen. The improvement in the Solvency II ratio to 232% was partially driven by, quote, a reduction in capital requirements from Solvency II reforms, end quote. The domestic UK reforms, Solvency UK, implemented following the EU Solvency II review, are designed to free up capital, particularly for insurers engaged in long-term infrastructure and productive investments. These reforms address various aspects, including the risk margin calculation, the volatility adjustment, and the capital treatment of matching adjustment assets. Globally, the overhaul of the Solvency II regulatory framework is set to offer more favorable capital treatment for specific investment classes, notably securitizations, which can lower capital charges for senior tranches backed by high-quality collateral. For LGen, these regulatory adjustments are expected to unlock latent capital, which can be either redeployed into higher-yielding assets to drive future PRT growth or returned to shareholders, supporting the $5 billion capital return plan. 4.3. Risk exposure analysis. LGen's business model involves taking on long-term liabilities and investing the corresponding assets to achieve a yield margin. This structure means the group is primarily exposed to market and longevity risk. Credit risk. The reliance on large asset portfolios to back the $92 billion liabilities, 8, means that credit risk is categorized as, quote, one of the group's most significant exposures, predominantly arising from the portfolio of corporate bonds and bond-like assets, 9. The quality and duration of the collateral are essential, with Solvency II stress tests calibrated based on bond ratings, AA, ABB, A. The Solvency II surplus is explicitly sensitive to spread widening, particularly when combined with other stresses, 9. Longevity risk. The pricing of long-term business requires setting assumptions for longevity, mortality, and interest rates, 2. While adverse experience may necessitate recalibrating these assumptions impacting profitability, LGen's business structure inherently manages this risk through diversification and scale. The $92 billion portfolio is large enough to allow for effective diversification and the utilization of global reinsurance strategies, ensuring that longevity risk is a known and priced component of the annuity contracts, reducing its unpredictable impact. V. Shareholder returns and dividend sustainability. 5.1. The $5 billion capital return commitment. LGen has clearly articulated its priority for shareholder returns, moving beyond a sole reliance on dividend growth to incorporate significant capital distribution through buybacks. The commitment to return over $5 billion to shareholders over 3 years, dividends plus buybacks, 1, serves as a powerful signal to the market, indicating management's conviction that the stock is fundamentally undervalued relative to its underlying capital strength and cash generation ability. The commitment commenced with an initial $500 million share buyback in 2024. 1. Alongside this initiative, the board confirmed its intention to maintain a supportive dividend policy, increasing the dividend by 5% for FY 2024 to 21.36 pence per share, with intentions to continue this growth for subsequent periods. The inclusion of a large buyback tranche strongly suggests that management perceives current market prices as a short-term anomaly relative to the group's true capital generating power, OSG, and the $14.8 billion store of future profit.
Dividend coverage analysis. LGen currently offers an exceptionally high dividend yield, approximately 8.45% TTM, 12, making its sustainability a primary concern for income investors. Assessing coverage using standard IFRS or even core EPS can be highly misleading. External commentary frequently notes that coverage against core EPS is relatively low, 19, as the core EPS of 20.23p FY 2024 is often slightly lower than the dividend per share, which was declared at 21.36p, 12. This comparison, however, ignores the structural cash flow dynamics of the life insurance sector. For long-term annuity writers, dividends are primarily paid from the operational surplus generation, OSG, which represents the deployable cash generated from the existing long-duration backbook. The FY 2024 OSG of $1,751 million comfortably covers the estimated cost of the dividend paid, approximately $1.23 billion, demonstrating robust coverage. 4 emphasizes that investors must use OSG, not volatile IFRS/core EPS, as the definitive metric for evaluating LGen's dividend safety. The group's ability to generate statutory profits over decades, represented in the SOFEP, ensures that capital release through OSG provides superior cash backing compared to traditional earnings coverage metrics. 19. Table 2, Historical and Projected Dividend per Share. Market Dynamics and Competitive Positioning. 6.1. Structural Growth in the PRT/BPA Market. Legal & General is the market leader in the UK bulk purchase annuity (BPA) market, which is experiencing powerful structural tailwinds. The sustained period of higher interest rates since 2020 has dramatically improved defined benefit (DB) pension scheme funding ratios, making buy-ins and buyouts more affordable and accelerating de-risking activity. 22. Industry experts forecast that the total UK DB schemes covered by insurers through BPA could approach £1 trillion by the early 2030s. 22. 2023 set a transaction record at $49.1 billion, and annual volumes are now expected to consistently surpass $50 billion, with some projections suggesting peaks of up to $80 billion annually. 22. Although total volumes in H1 2025 were relatively muted at $9.7 billion, the lowest since 2021, due to fewer mega deals, transaction activity remains high, particularly among smaller schemes. 23. This reliance on the timing of massive $1 billion-plus deals does introduce quarter-to-quarter earnings volatility, which the management's long-term 5 to 7% CAGR guidance aims to mitigate. 8. 6.2. LGen's market leadership. LGen maintains a clear leadership position in the PRT market, essential for securing the largest and most valuable deals. In H1 2025, LNG wrote $3.3 billion of buy-in or out volumes, commanding a 34% market share. Competitors are scaling up, including Aviva, 21% market share, and Just, 17%, 23. Competition is undoubtedly intensifying, marked by the re-entry of key players like M&G and the growing presence of other entrants such as Royal London, 22. This heightened competition risks eroding profitability margins. For LGen to maintain its strong volume growth and adhere to its target strain rate of below 4%, 8, it must differentiate itself beyond simple pricing. The critical factor is LGen's superior asset origination capability, derived from its merged asset management business. Access and effective management of high-quality long-term private assets provides regulatory capital efficiencies, allowing LGen to price deals more competitively than rivals who rely primarily on public credit markets. LGen's ability to source and hold these complex assets is a key competitive advantage in the race for mega deals. V. Valuation anomalies and peer comparative analysis. 7.1. The challenge of IFRS 17 and valuation distortion. The market valuation of LGen presents a significant analytical challenge, as standard multiples are severely distorted by IFRS 17 accounting regulations applied to long-term insurance contracts. The reported P/E ratio, derived from IFRS earnings, is exceptionally high, falling in the range of 52.4x to 60.4x, 6. This figure is dramatically detached from both the sector average, 9.5x, and the peer average, 10.7x, 6. If assessed conventionally, this multiple would suggest extreme overvaluation. Similarly, the price-to-book ratio is reported between 5.6x and 5.8x, 6, significantly above the typical PB for UK insurers. Aviva and Phoenix average PB is approximately 1.7x, 6. This high PB multiple in a financial firm is evidence that the market fundamentally believes the accounting book value, derived from assets minus liabilities, substantially underestimates the true economic value of LGen's specialized assets and embedded future profits. Specifically, it reflects market confidence in the quality and expected profitability of the $14.8 billion Store of Future Profit (SOFP) 2 and the unique capabilities developed through the group's integrated asset origination structure. The apparent contradiction of the extremely high P/E ratio is resolved by normalizing earnings using core operating EPS. Based on the FY 2024 core operating EPS of 20.23p, 1, and assuming a recent share price of approximately 250p, the calculated normalized P/E ratio is roughly 12.3x. This metric aligns closely with the peer group average, 10.7x, 6, validating the necessity of focusing on core operational metrics and confirming that the market is not pricing LGen based on volatile IFRS earnings. Comparative growth and analyst sentiment. While LGen offers an attractive current dividend yield, its projected growth rate lags that of some key competitors. LGen is targeting 6 to 9% core operating EPS growth through 2027-19. In contrast, a major competitor, Aviva, is targeting annual profit growth of approximately 11% toward a $1 billion operating profit target by 2026-19. This differential suggests that LGen may continue to underperform peers like Aviva in terms of near-term capital appreciation, reinforcing the view of LGen as primarily an income-driven investment. 12. Analyst sentiment reflects this nuanced position. The consensus rating for LGen is generally hold, 27. The median 12-month price target provided by analysts is 255.00p, 28, representing a modest upside from recent prices. The average target is 266.00p, 27, with a high estimate of 335.00 and a low of 210p, 28. This modest consensus supports the income investment case, suggesting that the market has not yet fully factored in the potential for value unlocking from the strategic realignment. Detailed risk assessment. 8.1. Market risk, credit and spread widening. The most critical financial risk for LGen stems from its core business activity, holding assets to match long-term annuity liabilities. This exposes the group to significant credit risk arising from the portfolio of corporate bonds and similar assets. 9. The group's Solvency II surplus is inherently sensitive to market fluctuations. Specifically, credit spread widening, a decrease in the valuation of corporate bonds, can materially impact the surplus position. Management acknowledges that adverse stresses, particularly market risks such as spread widening, are often correlated and can result in a combined impact that is larger than the sum of isolated stresses. 9. Furthermore, while rising interest rates have been a net positive for capital requirements, 3, an interest rate downstress, where negative rates are permitted, that is, no floor at zero rates, could significantly deplete the Solvency II surplus. 17. Maintaining the quality and management of this $92 billion asset base is paramount to the group's solvency stability. Execution risk. The success of the strategic pivot and the resulting shareholder returns commitment relies heavily on management's ability to execute complex, multi-year objectives. The Institutional Retirement Division must consistently achieve its ambitious target of £50 to £65 billion in PRT volumes over the next 4 years, while maintaining a low capital strain rate below 4%. Failure to meet these volumes or being forced to aggressively price deals due to competitive pressure, thus increasing capital strain, would impair OSG generation. In asset management and retail, the execution risk centers on the shift to the capital-light model. The group must successfully pivot the asset management division towards higher fee margin products, increasing the average fee rate and securing external committed capital. While simultaneously, the retail division must deliver on its £40 to £50 billion workplace DC net flow target 10 to ensure that 40% of retail profits are fee-based by 2034. Any shortfall in these key operational objectives would jeopardize the planned return to shareholders. 8.3. Regulatory and geopolitical risk. While regulatory changes such as Solvency UK are generally favorable, the implementation of such complex frameworks still presents inherent risks. The process requires firms to submit formal applications to regularize assets under new rules, and there remains residual operational and valuation risk associated with the transition. Furthermore, as a major international financial player, LGN remains subject to global macroeconomic instability, which could manifest through sovereign credit risk, changes in long-term mortality assumptions, or regulatory changes in international jurisdictions where it operates, such as the US and Bermuda. 9. Conclusion and investment recommendation. 9.1. Synthesis of investment case. Legal & General Group plc is an established market leader that is successfully leveraging secular growth trends in the UK pension de-risking market. The group possesses industry-leading financial resilience, evidenced by its 232% Solvency II coverage ratio and a strong capacity for operational surplus generation, £1,751 million in FY 2024. The strategic realignment under the new CEO, simplifying the structure, consolidating asset management capabilities, and committing to a capital-light future, is a necessary and decisive action intended to unlock the intrinsic value embedded in the group's £14.8 billion store of future profit. The most compelling aspect of the investment case is the high and well-covered dividend yield, which is structurally supported by stable long-term cash flows. The market currently overlooks this fundamental strength due to the distorted IFRS valuation multiples. By normalizing the PE ratio using core operating earnings, LGN is valued in line with its peer group despite its superior capital position and market leadership. The explicit commitment to return $5 billion through buybacks and dividends serves as a powerful catalyst for potential stock re-rating. 9.2. Investment. The assessment concludes that LGN should be viewed as a foundational income and value unlock play, offering substantial yield security backed by superior capital buffers. Justification: the market's consensus hold, median target 255 to 265p, fails to assign adequate credit to the security provided by LGN's substantial capital strength and its dominant position in the expanding PRT market. The target price of 280p is derived by applying a justified forward P core earnings multiple of 14x. This represents a modest premium to the calculated normalized core PE of 12.3x, reflecting the market leadership, the high Solvency II buffer, and the confidence generated by the £5 billion capital return commitment. The robust 8% plus dividend yield, securely covered by operational surplus generation, provides a strong income component and structural downside protection during the current period of strategic transition.